extend past this scalar view of economics. So gauge theory is one way that comes from physics. Do you find that way of exploring economics interesting? So outside of cryptocurrency, outside of the actual technologies and so on, just analysis of how economics works. Do you find that interesting?
Yeah, I think that if we're going to want to really make any scientific progress in economics, we have to apply much more computationally intensive and richer forms of mathematics.
So simulation perhaps, or
Yeah, when I was at MIT, I studied system dynamics. They taught it at the Sloan School. It was developed by Jay Forrester, who was an extraordinary computer scientist. And when we created models of economic behavior, they were all multidimensional, nonlinear models. So if you want to describe how anything works in the real world, you have to start with the concept of feedback. If I double the price of something, demand will fall, and attempts to create supply will increase, and there will be a delay before the capacity increases. There'll be an instant demand change, and there'll be rippling effects throughout every other segment of the economy, downstream and upstream of such a thing. So it's kind of common sense. But most economics, most classical economics, is always, taught with linear models, fairly simplistic linear models. And oftentimes, I'm really shocked today that the entire mainstream dialogue of economics has been captured by scalar arithmetic. For example, if you read any article in the New York Times or the Wall Street Journal, right? They just refer to there's an inflation number, or the CPI, or the inflation rate is X. And if you look at all the historic studies of the impact of inflation, generally they're all based upon the idea that inflation equals CPI, and then they try to extrapolate from that, and you just get nowhere with it.
so at the very least, we should be considering inflation and other economics concept as a nonlinear dynamical system. So nonlinearity, and also just embracing the full complexity of just how the variables interact, maybe through simulation, maybe have some interesting models around that.
Wouldn't it be refreshing if somebody for once published a table of the change in price of every product, every service, and every asset in every place over time?
You said table. Some of that also is the task of visualization, how to extract from this complex set of numbers patterns that somehow indicate something fundamental about what's happening. So like summarization of data is still important. Perhaps summarization not down to a single scalar value, but looking at that whole sea of numbers, you have to find patterns. Like what is inflation in a particular sector? What is maybe change over time? Maybe different geographical regions, things of that nature. I think that's kind of, I don't know even what that task is. That's what you could look at machine learning. You can look at AI with that perspective, which is like, how do you represent what's happening efficiently as possible? That's never going to be a single number, but it might be a compressed model that captures something beautiful, something fundamental about what's happening.
It's an opportunity, for sure, right? If we take, for example, during the pandemic, the response of the political apparatus was to lower interest rates to zero and to start buying assets, in essence, printing money. And the defense was there's no inflation. But of course, you had one part of the economy where it was locked down, so it was illegal to buy anything. But you couldn't, it was either illegal or it was impractical. So it would be impossible for demand to manifest, so of course there was no inflation. On the other hand, there was instantaneous, immediate inflation in another part of the economy. For example, you lowered the interest rates to zero. At one point, we saw the swap rate on a 30-year note go to 72 basis points. Okay, that means that the value of a long-dated bond immediately inflates. So the bond market had hyperinflation within minutes of these financial decisions. The asset market had hyperinflation. We had what you call a K-shaped recovery, what we affectionately call a K-shaped recovery. Main Street shut down, Wall Street recovered all within 6 weeks. The inflation was in the assets, like in the stocks, in the bonds. If you look today, you see that typical house, according to the Case-Shiller Index today, is up 19.2% year over year. So if you're a first-time home buyer, the inflation rate is 19%. The formal CPI announced is 7.9%. You can pretty much create any inflation rate you want by constructing a market basket, right? A weighted basket of products or services or assets that yield you the answer. I think that, the fundamental failing of economists is first of all, they don't really have a term for asset inflation, right?
What's asset hyperinflation? You mentioned bond market, swap rate, and asset is where the majority of the hyperinflation happened.
Yeah.
What's inflation? What's hyperinflation? What's an asset? What's an asset market? I'm going to ask so many dumb questions.
In the conventional economic world, you would treat inflation as the rate of increase in price of a market basket of consumer products, defined by a government agency.
So
Okay.
they have traditional things that a regular consumer would be buying. The government selects like toilet paper, food, toaster, refrigerator, electronics, all that kind of stuff, and it's like a representative basket of goods that lead to a content existence on this earth for a regular consumer.
They define a synthetic metric, right? I mean, I'm going to say you should have 1,000 square foot apartment, and you should have a used car, and you should eat, 3 hamburgers a week. Now, 10 years go by, and the apartment costs more. I could adjust the market basket by they call them hedonic adjustments. I could decide that it used to be in 1970 you needed 1,000 square feet, but in the year 2020 you only need 700 square feet because we've miniaturized televisions and we've got more efficient electric appliances, and because things have collapsed into the iPhone, you just don't need as much space. So now it may be that the apartment costs 50% more, but after the hedonic adjustment, there is no inflation because I just downgraded the expectation of what a normal person should have.
So the synthetic nature of the metric allows for manipulation by people in power.
Pretty much. I guess my criticism of economists is rather than embracing inflation based upon its fundamental idea, which is the rate at which the price of things go up, right? They've been captured by mainstream conventional thinking to immediately equate inflation to the government-issued CPI or government-issued PCE or government-issued PPI measure, which was never the rate at which things go up. It's simply the rate at which a synthetic basket of products and services the government wishes to track go up. Now, the problem with that is two big things. One thing is the government gets to create the market basket, and so they keep changing what's in the basket over time. So, I mean, if I said 3 years ago you should go see 10 concerts a year, and the concert tickets now cost $200 each, now it's $2,000 a year to go see concerts. Now I'm in charge of calculating inflation, so I redefine, your entertainment quota for the year to be 8 Netflix streaming concerts, and now they don't cost $2,000, they cost nothing, and there is no inflation, but you don't get your concerts, right? So the problem starts with continually changing the definition of the market basket. But in my opinion, that's not the biggest problem. The more egregious problem is the fundamental idea that assets aren't products or services. Assets can't be inflated.
What's an asset?
A house. a share of Apple stock, a bond, a Bitcoin is an asset, or a Picasso painting. So,
Not a consumable good. Not
yeah,
a not an apple that you can eat.
right. If I throw away an asset, then I'm not on the hook to track the inflation rate for it. So, what happens if I change the policy such that, let's take the classic example, $1 million bond at a 5% interest rate gives you $50,000 a year in risk-free income. You might retire on $50,000 a year in a low-cost jurisdiction. So the cost of Social Security or early retirement is $1 million when the interest rate is 5%. During the crisis of March of 2020, the interest rate went on a 10-year bond went to 50 basis points. Okay. So now the cost of that bond is $10 million. Okay. The cost of Social Security went from $1 million to $10 million. So if you wanted to work your entire life, save money, and then retire risk-free and live happily ever after on a $50,000 salary, living on a beach in Mexico, wherever you wanted to go, you had hyperinflation. The cost of your aspiration increased by a factor of 10 over the course of, some amount of time. In fact, in that case, that was like over the course of about 12 years, right? As the inflation rate ground down, the asset traded up, but the conventional view is, oh, that's not a problem because it's good that it's good that the bond is highly priced because we own the bond. Or what's the problem with the inflation rate in housing being 19%? It's an awful problem for a 22-year-old that's starting their first job, that's saving money to buy a house. But it would be characterized as a benefit to society by a conventional economist who would say, well, housing asset values are higher because of interest rate fluctuation, and now the economy's got more wealth. And so that's viewed as a benefit.
So what's being missed here, like the suffering of the average person, or the struggle, the suffering, the pain of the average person, like metrics that captured that within the economic system. Is it when you talk about
one way to say it is a conventional view of inflation as CPI understates the human misery that's inflicted upon the working class and on mainstream companies by the political class. And so it's a massive shift of wealth from the working class to the propertied class. It's a massive shift of power from the free market to the centrally governed or the controlled market. It's a massive shift of power from the people to the government. And maybe one more illustrative point here, Lex, is what do you think the inflation rate's been for the past 100 years?
Are we talking about the scalar again?
If you took a survey of everybody on the street and you asked them, what do they think inflation was? What is it? You remember when Jerome Powell said our target's 2%, but we're not there?